Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature. None of it should be relied upon as any form of personal advice. FP Markets does not know your personal scenario, nor your personal financial goals, and therefore none of it should be relied upon as any form of advice at all. It is just general in nature only. I'm going to move to something slightly different this week because I can't get away from what's actually transpiring in the Australian bond market right now. It is something that I don't think any of us have really seen in Australia. We've seen it overseas, but not here in Australia. To see a tantrum, which is exactly what it is, as hard as it's going right now, is an absolute wake-up call that next year will be quite a different year for how policy is run in this country. The RBA has absolutely lost control of its policy, and that is something that I don't use lightly, and I don't say it lightly either. To see them not actually continue to hold on to the yield curve control mechanism and not only let it go, but let it absolutely fly, as seen by this chart here, is an absolute indictment for what's been going on at Martin Place. And that is a reasonable conclusion to make. Yes, they've been caught off by the fact that inflation is moving at a rate faster than they expected. Yes, growth is doing quite well, and that their metrics that they had probably in the March 2020 meeting have probably been done. They didn't necessarily need to keep going with quantitative easing or the YCC or any of the other mechanisms outside of interest rate controls going ahead as far as they have. But they now have to work very, very hard on Tuesday to explain what they're going to do to slow this down, because the market is now suggesting that they're going to have out of cycle rate rises. Not only that, we're actually going to have a very significant slowdown in lending in this country coming over the next 6 to 12 months as rates rise. You cannot have a 3-year at that current level, or a 10-year for that matter, above 2% and not see that translate through to lending rates. Interest sensitive markets, equities, bonds, FX are going to feel this very, very quickly, and it's a question of what the RBA now does on Tuesday to try and moderate that. Interesting so far that the FX market, particularly Aussie dollar, hasn't really reacted to it yet. And that is what we now need to watch. It's why Tuesday is such a live event, because that movement in the bond market, that massive sell-off, suggests that there is not only rate rises coming, that maybe the RBA just does not have the capital to do the kind of defence it needs to make sure that we continue the way we are. So watch that space very closely. What's going on in the bond market right now is going to be the biggest story going around for the next 6 to 12 weeks, and realistically for the next 6 to 12 months.